For 3 generations, society made teenagers the exact same promise. Take on debt now, hand it to a university, and the university will hand you back a stable, middle-class life on the other side. That promise didn't just weaken, it quietly stopped being true. Right around the same time, almost nobody was watching the fine print. And the ones who noticed first were mostly the institutions doing the writing. This is the great overeducation swindle, and it has been running quietly for decades. And once you follow the money, the university stops looking like a school and starts looking like something else entirely. Tuition was never supposed to behave like this, and for most of the 20th century, it didn't. Since 1980, the price of a college degree has climbed by well over 1,000%, while general inflation over that same stretch moved a tiny fraction of that distance. A single price cannot outrun the entire economy for 4 straight decades by accident. It requires an institution that has figured out something the rest of the economy hasn't: a captive customer, a legally protected credential, and a customer base too young and too desperate to negotiate the terms of the single biggest financial decision of their life. The bill for all of that now sits at $1.86 trillion, spread across more than 42 million borrowers, each one carrying an average balance north of $40,000 before they have ever received their first real paycheck, and often before they have fully understood what they signed. Here is where the story stops sounding like an education story and starts sounding like a finance story. Follow the money that flows into a major university, and a strange amount of it never touches a classroom at all. It flows instead into an endowment, a permanent investment fund sitting quietly behind the campus. And at the largest schools, that fund now looks almost nothing like a school savings account. It looks like a hedge fund with a football team attached. Harvard's endowment alone sits at nearly $57 billion. 41% of it is parked in private equity. Another 31% sits in hedge funds. That is 72 cents of every dollar, invested exactly the way Wall Street's most aggressive institutional funds invest. Not the way a nonprofit teaching institution is supposed to behave. The top 20 university endowments in the country now hold more than $500 billion combined, and in fiscal 2024, Harvard's fund alone returned 10%. Yale's returned nearly 14%, outperforming plenty of professional hedge funds charging clients 2 and 20 for the privilege. And that is exactly when the disguise fell away. A university with a football team and a philosophy department is also, quietly, one of the most sophisticated private equity investors on the planet. Funded in no small part by tuition dollars extracted from 18-year-olds who had no other legal way to compete for the jobs waiting on the other side of that diploma. Here's the part that should genuinely disturb every current freshman. While the price of the degree kept climbing, the value of the degree on the other end of that trade was quietly getting cut in half underneath their feet, in real time, mostly outside their view. The share of job postings requiring a bachelor's degree has fallen from 51% in 2017 to roughly 44% today. 70% of employers now say they use skills-based hiring, up from 65% barely a year earlier. Companies like IBM, Google, Apple, Delta, Bank of America, and Walmart have all formally dropped degree requirements from major categories of roles. IBM alone now fills nearly half of its American positions through a program explicitly built around candidates with no 4-year degree at all. But here is the twist inside the twist. Researchers at Harvard Business School and the Burning Glass Institute discovered that nearly half of the companies who announced they had dropped the degree requirement did so in name only. Fewer than 1 in 700 actual hires at those firms ever went to a candidate without a degree. The requirement vanished from the job posting. It did not vanish from the hiring manager's head or from the quiet assumptions still running the interview room, so the credential got quietly devalued in public while still being quietly demanded in private. Teenagers were sold a rising price for a shrinking guarantee, and the shrinking part was the one nobody bothered to put in the marketing brochure. So, is the modern university a predatory financial engine? Or is it still doing exactly what it always did? One argument says none of this is a scandal at all. Endowments exist precisely so universities can operate independently of any single year's tuition revenue or government funding. And sophisticated, diversified investing is simply prudent stewardship of donated money on a multi-decade horizon. A college degree, on average, still correlates with meaningfully higher lifetime earnings than no degree at all, whatever the shifting hiring headlines say in any given year. The other argument says correlation is doing an enormous amount of work in that sentence. If the same ambitious, disciplined 18-year-olds who succeed with a degree would likely have succeeded without one, the degree isn't creating the outcome. It is simply certifying a trait that was already there, at a price that has grown completely disconnected from that certification's actual usefulness. And an institution running 72 cents of every endowment dollar through private equity and hedge funds isn't a passive bystander benefiting from tuition. It is an active financial participant, extracting capital from teenagers with no leverage to say no. Both of these can be true at once. A degree can still correlate with real economic advantage on average, and the price charged for that credential can still have detached completely from any reasonable measure of its actual cost or value. With the gap between those two facts quietly absorbed by an entire generation of borrowers who had no way to see it coming. The university was never just a school. For the wealthiest institutions, it became a permanent, tax-advantaged investment vehicle, one that happens to run a campus as a side operation, funded upfront by 18-year-olds trading years of future income for a credential whose actual market value was quietly shrinking the entire time they were paying for it, one tuition bill at a time. That is the same pattern this channel keeps finding, in a new building each time, wearing a different name on the door, whether it is a bank, a landlord, or a university admissions office. A system that looks like it exists to serve you, quietly optimized instead around extracting value from the fact that you had no real alternative and no real leverage to ask for a better deal. A school that quietly runs 72 cents of its endowment through private equity and hedge funds, while selling 18-year-olds a shrinking credential at a rising price. That is exactly the kind of thing this channel exists to find. Subscribe to Bold Ledger if you want more of it. I will see you in the next breakdown.